Ever found yourself daydreaming? Maybe scrolling through those stunning photos of villas, perhaps one with an infinity pool looking out over a turquoise sea,
Oh,
and
absolutely.
thinking, that's it, that's where I'm investing. Maybe somewhere truly amazing like Phuket.
Phuket is definitely a dream spot for many. It's
Yeah,
easy to get swept away.
totally. By the beauty, the sun. But here's the thing, right? Real financial smarts aren't just about picking the perfect spot.
No, not at all.
It's about making really smart decisions that protect your investment. Avoiding costly surprises, making sure you're not paying more tax than you absolutely have to.
Precisely.
So today, we're doing a deep dive. This is basically your shortcut to being super well-informed on exactly that.
That's the plan. And for this, we're digging into some key insights from Phuket Property, a guide to smart tax planning. Really essential stuff if you're looking at the Thai market.
Okay. And where's this guide from?
It comes straight from Ocean Worldwide. They're a luxury real estate agency actually based right there in Phuket since 2004.
Wow, long time.
Yeah, they really know their stuff. Focused on luxury homes in Phuket and Koh Samui. Their director, Sandra O'Neill, she's helped literally thousands of families and investors navigate this whole landscape over the years.
So they've seen it all.
Pretty much. So our mission today, break down the tax planning essentials for Thai property. Understanding the rules, which, believe me, can change, and leveraging exemptions. Getting this right from day one, it can make a huge difference to your bottom line, your overall returns.
Okay, let's unpack this then. Because when you think about investing in Phuket property, it's clearly about way more than just the price tag or, those tempting rental yields.
Oh, definitely.
You really have to grasp the tax side. And you mentioned it's not static,
Yeah,
especially for foreigners.
exactly. What's really fascinating or maybe challenging is how quickly Thailand's tax landscape can evolve. It's dynamic.
So people thinking the rules are set in stone,
Mhm.
that's a mistake.
That's a big one. Many investors assume tax rules are fixed, but for property, particularly if you're investing from overseas, staying absolutely current is critical. What held true a year or two ago might genuinely be different now.
Like what sort of thing?
Well, imagine thinking, a certain repair cost is fully deductible, but then a new regulation comes in and suddenly it's not, or only partially. That's the kind of costly surprise you avoid by staying vigilant. It's like keeping an eye on the weather forecast, really.
Okay, so constant vigilance. Beyond that general fluidity,
Hmm.
what are some key things foreign investors specifically need to watch out for? Like, does how you own the property actually matter tax-wise?
Oh, absolutely. Huge difference. Whether you own it as an individual versus, say, through a company structure, that can lead to vastly different tax outcomes down the line.
Right.
And this is where it gets interesting, the interplay between Thai tax law and the tax laws back in your home country.
Ah, the cross-border stuff.
Yeah. Exactly. Understanding those implications and, crucially, whether there's a double taxation agreement, a DTA between Thailand and your home country, that's vital.
To avoid paying tax twice.
Precisely. Or just paying more than necessary. It's all about efficiency.
This brings up a really important point then.
Yeah.
What's the best way to approach this? Does it really pay off to plan the tax stuff right from the get-go, before you even sign anything?
Honestly, the value of proactive tax strategy, you just can't overstate it. The absolute best approach is thinking about tax from day one.
Before you even fall in love with a property.
Ideally, yes, or at least concurrently. Imagine buying and then realizing later a different ownership structure could have saved you, say, 30% on capital gains when you sell.
Ouch.
Yeah, that's the kind of thing day one planning helps avoid. It means structuring the investment smartly from the start, choosing the right ownership, knowing what expenses you can claim, planning your exit. It's all foresight that saves you real money.
Okay, so we've accepted the day one planning mantra. Let's talk specifics. How can investors actually structure their finances to really optimize things for their Phuket property? Like you said, it's not just the purchase price, it's what you keep after tax.
Right, that's the key metric. If we connect this to the bigger picture, one common strategy is using holding companies.
Okay.
This could be a local Thai company or sometimes even an offshore entity. It depends on your circumstances, home country rules, all that.
And the benefit.
The idea is the company owns the property, not you directly. This can offer significant advantages sometimes, tax liability, especially for capital gains or maybe how dividends are treated. It acts like a legal shield, potentially taxed differently than personal ownership.
So it's like putting the property in a separate box.
Exactly, a separate box that might have different tax rules applied to it.
And you mentioned avoiding being taxed twice, that nightmare scenario. That's where those double taxation agreements, the DTAs, come in.
Correct. They are specifically designed to stop you being taxed on the same income, say, rental income, both in Thailand and back home.
Can you give us a practical example? How would that work for someone renting out their Phuket villa?
Sure. So take rental income. DTA might say, okay, Thailand has the first right to tax that income. Or maybe it says you pay tax in Thailand and then your home country gives you a tax credit for what you paid there.
Ah, so you're not paying the full whack twice.
Exactly. So if you paid, say, 15% tax in Thailand, your home country might credit you that 15% against your tax bill there, reducing or even wiping out the tax owed back home on that specific income.
That's huge.
It can be. And this flows right into managing capital gains tax when you eventually sell. How much you pay depends on things like how long you owned it and, crucially, that ownership structure we talked about.
How so?
Well, selling a property you own directly might trigger tax at one rate, maybe a progressive one, but selling shares in the company that owns the property, that could be taxed differently, maybe a flat rate, or even be exempt under certain conditions if it's structured correctly from the start.
So planning the exit is as important as planning the entry.
Absolutely critical. And agencies like Ocean Worldwide, who are right there in Phuket and deal with this luxury market day in, day out, they can offer really valuable insights into what structures work best.
Okay, so the big picture structure is sorted. Day one planning done. What about the ongoing stuff? Year to year, how do you keep more of your rental income, for example? How do you unlock more savings?
Right. This is about maximizing your allowable investment expenses.
Okay.
Loads of costs tied to owning property can be offset against your income.
Like what kind of costs?
Oh, things like property management fees, necessary repairs, regular maintenance, insurance premiums, even mortgage interest if you have a loan.
Mhm.
But the absolute key here, and I can't stress this enough, is meticulous record keeping. Receipts, invoices, bank statements, everything.
The boring bit.
Maybe, but think of those records as your invisible tax shield. Seriously, a missing receipt for a big repair that could cost you thousands in disallowed deductions. These records are genuinely your best friend here.
Got it. Keep everything.
Yeah.
Now, here's one I've heard about that sounds a bit, well, clever. Depreciation. Using property depreciation benefits. How does that work? It's not cash out of pocket, right?
Exactly. It's a non-cash deduction, which makes it powerful. It's basically an accounting allowance for the fact that buildings, wear out over time or become obsolete.
Even if the property value is going up?
Yep. Even if the market value is rising, for tax purposes, you might be allowed to deduct a portion of the building's value each year. It reduces your taxable income without you actually spending any cash in that year, makes the investment more tax efficient.
That sounds like a must-do.
It often is. But again, and this is a recurring theme, you need to stay on top of regulation changes. Tax laws, especially in dynamic economies like Thailand's, they don't stand still.
Yeah, keeping an eye on the weather thing again.
Precisely. It's less about predicting storms far off, more about checking the immediate forecast constantly. Subscribe to updates, talk to local tax advisors. It avoids nasty surprises, ensures you don't miss out on new savings opportunities.
Okay, this is making sense. Beyond the pure numbers and structures, let's shift a bit. What about the legal side of the actual property transactions in Phuket? How much does the deal structure, the paperwork itself, matter for tax?
Oh, hugely. The legal structure and the tax outcome are totally intertwined. It's crucial to review how a transaction is structured, especially with any new laws. Is your current setup, say, company ownership versus direct, still the most efficient? Is it compliant?
Compliance is key, obviously.
Absolutely. Which ties back to keeping those meticulous records of income and expenses and understanding things like withholding tax on rental income.
Withholding tax, what's that?
It means a portion of the rent your tenant pays might be withheld by them or by a managing agent and paid directly to the Thai tax authorities on your behalf. You need to account for that in your own tax filings. It's common in many countries.
Right. And you also need to be careful about how you classify income, right? Why is it so important to distinguish between, say, rent versus profit from a sale? Isn't it all just income?
Common misconception. They are definitely not taxed the same way. Tax treatment can differ significantly. Rental income might face that withholding tax at a certain rate. Capital gains from a sale. That follows a whole different set of rules, often based on how long you held it, the ownership structure.
Okay.
Understanding those differences helps you plan properly and stops you accidentally classifying income in a way that triggers a higher tax bill.
Okay, so this is where it gets really interesting, right? Thinking strategically beyond just the initial purchase. Not just avoiding problems, but actively seeking opportunities. What are some of those more advanced plays investors might consider?
Yeah, definitely. One area is evaluating off-plan opportunities, buying before it's built.
Pros and cons there, I imagine.
For sure. You might get a better price, but you need to consider the tax implications of the payment schedule, any developer incentives. Sometimes these can be structured to, perhaps, defer some tax liability, which helps with cash flow. Working with reputable developers, like Sharna Sara, for instance, who are known for quality, is important here too, as they often have clear structures.
Makes sense. What else?
Also, constantly reassessing your holding period and exit strategy. Remember how we said selling shares versus selling the property direct can have different tax impacts? Knowing how long you plan to hold and how you plan to sell influences decisions today.
Right.
And finally, really digging deep into those tax treaty benefits. Don't just assume it only covers rental income. Look at all potential income streams and see how the DTA might help reduce your overall tax burden. It requires some homework or good advice.
Let's broaden out a bit now. Thinking about the Phuket property market as a whole, it's known for being pretty resilient, right? But how do these ongoing tax changes affect the bigger picture?
Investors are definitely recalibrating, no question. What looked like a great deal 5 years ago might need reassessing under current tax rules. People are adapting their strategies to fit the new fiscal norms, trying to maintain profitability while, staying fully compliant.
So are we seeing an impact on property values, particularly at the high end, where Ocean Worldwide operates? Is it pushing prices down?
It's a bit mixed, honestly. Some analysts might point to short-term dips, maybe for those ultra-luxury property, particularly attractive to foreign buyers who are now facing new tax considerations.
Temporary adjustment.
Potentially. As the market digests the changes and investors figure out the new landscape, things could well level out. What's really key, long-term, is enhancing investor confidence through transparency.
Clear rules, consistently applied.
Exactly. Even if there are new taxes, a clear, predictable system builds trust. That attracts serious, long-term investors, not just speculators. It could lead to a steadier investment flow. And maybe, just maybe, make things like real estate investment trusts, REITs, a more appealing option for some.
REITs, how do they fit in?
They're basically companies that own portfolios of income-producing real estate. Investing in a REIT lets you get exposure to large-scale property without direct ownership hassles. In a more transparent tax environment, they could gain traction.
Interesting. Okay, let's get back to the nitty-gritty of ownership itself, the different ways you can actually hold property in Phuket, because the options have pretty significant tax consequences, right?
Huge consequences. It's definitely not one size fits all. The first big distinction is condominium versus land ownership for foreigners.
What's the difference there?
Thai law is quite restrictive about foreigners owning land directly. Usually it requires setting up a Thai company or using long-term leaseholds. Condos, though, are different. Foreigners can own condos freehold, outright, within a set quota, usually up to 49% of the units in a building.
And that direct ownership is simpler tax-wise.
Generally, yes. The tax treatment for rental income and capital gains on a condo owned directly in your name tends to be clearer than navigating the taxes for a company structure holding land or leasehold.
Which brings us to leasehold versus freehold. You mentioned foreigners often use leasehold for land.
That's right. Freehold means you own it outright, common for Thai nationals and for foreigners within that condo quota. Leasehold is different. It grants you the right to use the property for a long term, typically 30 years, often with options to renew, but you don't own the land itself.
And how does that affect taxes, especially when you sell the lease?
Significantly. Selling a leasehold right is generally taxed differently from selling a freehold property title. The capital gains calculations can vary. Again, navigating these foreign ownership regulations, the condo rules, the leasehold structures is absolutely essential. Get it wrong, and you could face serious legal trouble and financial penalties. Getting advice on the right structure for you is paramount.
Okay, now a topic maybe people don't love thinking about, but it's critical: estate planning. Inheritance tax for Phuket properties. What happens when the owner passes away?
Yeah, not the cheeriest subject, but vital. The absolute cornerstone here is having a valid last will and testament, preferably one that's valid under Thai law or recognized by it.
Why is that so crucial?
Because without a will, Thai law dictates who inherits your assets, the rules of intestacy, and that might be very different from what you actually want. A will lets you specify exactly who gets your Phuket property, family, friends, anyone.
What about inheritance tax itself in Thailand? Is it harsh?
Actually, Thailand's inheritance tax regime is generally considered quite favorable compared to many Western countries. The rates and thresholds are often less burdensome, but navigating the process, transferring titles, dealing with any tax due that definitely requires local legal help. An expert can ensure your assets are transferred efficiently and according to your wishes, minimizing fuss and potential disputes.
So despite all these complexities, the changing taxes, the legal structures, the planning Phuket's property market keeps drawing people in, doesn't it?
It really does. It's shown remarkable resilience. You still see strong rental yields, especially in the main tourist areas. Plus, things like the Thailand Elite Visa and the newer long-term resident or LTR visa program, they signal that the government is still keen on attracting foreign investment and residents.
Those visa programs make a difference.
They do. And overall, Thailand's real estate market still has major appeals. Generally lower property taxes and transaction costs than many places, plus ongoing infrastructure improvements, better roads, airport expansions in Phuket, making the island even more accessible and attractive.
It's still a great lifestyle proposition.
Absolutely. And with the right advice and planning, it can definitely be a rewarding financial venture too.
So, wrapping this all up, what's the big takeaway for you, the listener, dreaming of that Phuket villa?
I think it boils down to this. The indispensable value of getting expert advice cannot be stressed enough.
Don't try to DIY the tax and legal stuff.
Please don't. The value of local legal and tax professionals who live and breathe this stuff, who understand the nuances, the ins and outs of Thai law, the ownership structures, tax declarations, capital gains, rental income, it's immense. They save you from costly mistakes and find efficiencies you'd never spot.
And a good real estate agent, too.
Definitely. A knowledgeable agent like the team at Ocean Worldwide who really knows the Phuket market, especially that luxury segment, they can guide you away from pitfalls and connect you with the right legal and tax people, too. Many reputable firms offer free initial consultations, which are a fantastic way to just start the conversation.
A low-risk first step.
Exactly. Gauge the complexity, understand the basics before you dive in deep.
And there we have it. Thinking about buying property in Phuket, it's definitely more involved than just picking a place with a nice view. Getting your head around the tax implications, how it fits your financial picture. Maybe not the most thrilling part, right?
Haha, probably not the highlight reel moment.
But it is absolutely crucial. Getting it right protects your investment, stops those nasty surprises later, and makes sure your tropical dream doesn't morph into some kind of financial nightmare.
Couldn't agree more. And maybe the final thought for you to consider is this. A thorough understanding of the tax side, combined with that crucial expert guidance. It's not just about ticking boxes and staying compliant. It's actually about unlocking the true potential and the long-term financial health of your international property investment. It's about making your Phuket property not just a dream home, but a genuinely smart, stable, and profitable asset for your future.